Welcome back to the ProTicker Podcast, your Monday morning edition covering major financial magazine headlines, everyone. In today's deep dive, we're cutting through the noise to bring you the most critical insights from a stack of recent financial headlines and analyses. We're drawing from comprehensive reports by Reuters, CNBC, Bloomberg, and Yahoo Finance today. Our mission for you today is to give you a clear, concise, and captivating understanding of what's really driving markets and innovation right now so you can feel truly well-informed.
Yeah, and what's fascinating here is how events that seem worlds apart, from geopolitical tensions in the Middle East to these rapid advancements in AI and strategic shifts in e-commerce, they're all interconnected. They're sending ripples across global markets. We'll try and connect these dots for you, helping you understand the why behind the headlines.
It really feels like the global economy is constantly navigating choppy waters, doesn't it? And this past weekend certainly added to the turbulence. Let's jump straight into those geopolitical tremors that rocked the markets. Reuters reported that on Saturday, June 21st, 2025, the U.S. conducted airstrikes on three key Iranian nuclear sites, Fordo, Natanz, and Isfahan. This marks the first direct U.S. action against Iran in this conflict. And what's particularly noteworthy, I think, is that it happened unexpectedly, even ahead of President Donald Trump's self-imposed two-week decision timeline he mentioned. He claimed the sites were, quote, totally obliterated, and even hinted at regime change, posting on Truth Social with the phrase mirroring his campaign slogan, making Iran great again.
And Iran's response, as reported across multiple outlets like CNBC, was swift and forceful, at least rhetorically. Their foreign minister, Abbas Araghchi, called the strikes outrageous and stated Tehran reserves all options for defense, threatening everlasting consequences.
Right, big words.
Big words. And we even saw Iran's parliament back a proposal to close the Strait of Hormuz, that crucial choke point handling about 20% of global oil supply. Initially, the oil market reacted dramatically, just as you'd expect. Brent crude surged, as much as 5.7% to $81.40 a barrel.
WTI jumped, too.
It did. But what's equally striking, and Bloomberg highlighted this, is how quickly those gains just vanished. Brent fell back to near $77, and WTI dropped below $74, all within hours.
That rapid pullback in oil prices is genuinely intriguing, isn't it? Despite such a significant geopolitical escalation, the initial market shock seemed to just evaporate. What, in your analysis, explains this swift reversal?
Well, I think it boils down to market skepticism and historical patterns, really. Analysts are largely doubtful that Iran will actually follow through and fully close the Strait of Hormuz. I mean, consider the implications. Doing so would severely harm Iran's own economy, cutting off their primary revenue stream. And crucially, it would alienate major customers, especially China. This aligns with past patterns where we've seen similar threats from Iran. While alarming, they just didn't fully materialize.
So the bark is worse than the bite, potentially?
Potentially. Now, JP Morgan, for instance, they warned that a full closure could drive oil to $150 per barrel and push U.S. inflation way up to 5%. That's the worst-case scenario. However, experts like those from RBC Capital Markets and Mizuho, they believe a full closure is pretty improbable. Though they do concede Iran could use what they call asymmetric capabilities, think cyber attacks, proxy actions, maybe targeted disruptions that fall short of full closure, just to raise economic costs.
Okay, sort of a calibrated response rather than all-out economic warfare.
Exactly. It's a calculated risk they've historically avoided because the blowback, well, it would likely be too severe for their own economy.
That makes sense. Speaking of calculated risks, let's broaden our view to the overall market and currency impacts. Yahoo Finance and others detailed this. The U.S. dollar initially surged, as you'd expect in a safe haven move. It gained against the Japanese yen, the euro, the British pound. But analysts are already suggesting this dollar strength might be short-lived. What are the underlying currents driving that caution?
Yeah, it's precisely because those fundamental concerns haven't gone away, right? Concerns about U.S. fiscal policy, the ongoing trade wars, weakening international demand for U.S. assets. The dollar index, for example, it's actually down over 8% this year. That points to a broader underlying weakness.
Okay, so the knee-jerk reaction is there, but the fundamentals are still weak.
Pretty much. And that the Japanese yen presented a fascinating paradox here. Traditionally, it's a safe haven asset in times of global turmoil, yet it's surprisingly weakened significantly, like 2.4% against the U.S. dollar, 1.4% against the Swiss franc.
Wow, that is counterintuitive.
Yeah.
Why?
The reason, as explained by Citi analysts, is Japan's heavy reliance on oil imports. Almost all of it. So a spike in crude prices directly worsens Japan's already delicate trade balance. That diminishes the yen's appeal. especially, with a dovish Bank of Japan unlikely to raise rates anytime soon. Cities even reiterated forecasts for the yen to weaken further, maybe 150 per dollar by September.
Okay, so Japan's energy vulnerability outweighs its safe haven status in this specific scenario.
It seems so. Looking at Asian markets more broadly, most Asia-Pacific markets, including Japan's Nikkei 225 and South Korea's Kospi, saw modest declines, about 0.13%, 0.24% down. Interestingly, Hong Kong's Hang Seng Index bucked the trend, rising 0.67%, and U.S. equity futures, after an initial dip, actually ticked higher.
This raises an important question then. Why aren't global markets reacting more severely? Historically, you'd expect maybe a much stronger flight to safety, more sustained drops. What stands out to you here?
Yeah, that's the million-dollar question, isn't it? What's fascinating is how often markets, in the longer run, tend to look past these immediate geopolitical shocks. They refocus on core economic fundamentals. Morgan Stanley strategists, for example, they point to historical data. It indicates geopolitical sell-offs tend to be brief. The S&P 500 often recovers strongly, think up 2% in 1 month, 3% in 3 months, and even 9% in 12 months on average after these kinds of events.
So statistically, these shocks are often buying opportunities, historically speaking.
Historically, yes, though past performance is no guarantee, of course, but it speaks to the market's relentless focus on corporate earnings and economic growth over short-term political noise. It's a powerful reminder for you as a listener that knee-jerk reactions often miss the long-term trend, suggesting that unless a geopolitical event fundamentally disrupts global trade or corporate earnings for an extended period, markets tend to look past the headlines surprisingly quickly. In fact, some strategists, like Dan Ives from Wedbush, even framed the destruction of the nuclear facilities as a kind of relief, reducing the long-term nuclear proliferation threat. A very specific take.
An interesting perspective, certainly.
And we saw specific sector movements reflecting this. Defense stocks like Lockheed Martin, RTX Corporation, they saw gains. Meanwhile, travel-related stocks in Asia-Pacific Japan Airlines, Qantas, they fell, likely due to those higher oil prices and fears of supply disruptions.
Okay, so it's a testament to market resilience, maybe a bit of desensitization as well. But the ripples from this conflict, they extend far beyond just oil and currencies. They land squarely on the desk of the Federal Reserve. How do these geopolitical events add a new layer of complexity to the Fed's already complicated path, especially given their divided dot plot?
Yeah, the Fed was already grappling with significant uncertainty. That was reflected in that divided dot plot, the chart showing where each Fed official expects rates to be. It came out of their last meeting. Some officials were forecasting 2 rate cuts in 2025, while a sizable number, 7 officials actually, were predicting none at all, 0 cuts.
Quite a spread.
A big spread. Now, throw in a potential sustained rise in oil prices, especially coupled with President Trump's tariffs, that could significantly add to inflationary pressures. It could potentially push U.S. inflation towards that challenging 5% mark. This creates a classic dilemma for the Fed.
And what are the 2 main schools of thought emerging from that dilemma? How might this affect us, consumers and investors?
Exactly. Well, on one hand, you have some hawks in the Fed who would argue for holding rates higher for longer. They want to combat any resurfacing inflation, particularly if oil prices sustain a climb.
Makes sense. Fight inflation first.
Right. But on the other hand, there's a counterargument. An extended oil shock could severely dent consumer demand and business activity, and that could potentially lead to earlier rate cuts to protect economic growth and jobs.
So a real catch-22. Damned if they do, damned if they don't, almost.
It's a very delicate balancing act. Fed Chair Jerome Powell himself noted recently that historically, Middle East turmoil tends to cause temporary oil spikes, but they don't often have lasting effects on broader inflation. And crucially, the U.S. is far less dependent on foreign oil now than it was back in the oil shocks of the 1970s. That helps mitigate some immediate inflation fears.
Okay, that context is important. Despite these concerns, though, the Treasury market's reaction has been, well, unusually muted, hasn't it? Why aren't we seeing more volatility there?
Indeed. While U.S. Treasury yields did inch higher, the market's overall reaction was quiet, very subdued. This is attributed to those persistent underlying concerns we mentioned: U.S. fiscal policy, continued trade deficits, the potential for increased Treasury supply down the road. These sort of structural issues can sometimes overshadow immediate geopolitical shocks in the bond market.
So bigger, slower-moving worries are keeping yields anchored, perhaps.
That seems to be part of the story. In fact, some Swiss private banks are even recommending European bonds as potentially safer alternatives right now. They cite attractive valuations and possibly less inflation risk in Europe. Looking ahead, May's Personal Consumption Expenditures Price Index, PCE, that's the Fed's preferred inflation gauge, is due this Friday. That data will be absolutely crucial in shaping expectations for future rate decisions.
Definitely one for everyone to watch on Friday. Okay, while the world grapples with these macro uncertainties, shrewd companies are finding their own paths to growth. And here's where it gets really interesting. Let's shift our focus to how some major companies are navigating this complex environment. Take Amazon. They're making a significant push into premium beauty. CNBC highlighted this as a clever strategy, a way to buffer against potential tariff impacts on their massive Prime Day sales by focusing on high-margin luxury goods. What makes this strategy particularly effective right now?
Oh, it's a very smart maneuver for Amazon. They're leveraging a high-margin segment to really fortify their position. Their Amazon Premium Beauty sales rose by nearly 20%. That's $15 billion between April 2024 and April 2025.
20%, that's huge growth.
It is. It significantly outpaces the general beauty market's 14% growth, and even Amazon's overall online store sales growth, which is about 5%. The reason it works is pretty simple. Premium beauty items are small, expensive, easy to ship. That yields higher margins.
Less sensitive to shipping costs and tariffs, perhaps?
Exactly. And brands like Estée Lauder's Clinique, Olaplex, L'Oreal's Urban Decay, Unilever's Dermalogica, brands that initially kind of shunned Amazon, they're now embracing the platform. This shift is partly due to Amazon cracking down on counterfeits, which was a big concern for these brands. And importantly, many of these brands source locally from the U.S. and Canada, which reduces the direct tariff impact.
Ah, okay. Local sourcing is key there.
And this push also helps Amazon compete directly with established beauty retailers like Ulta Beauty and Sephora. It helps them attract older, higher-income shoppers, broadening their demographic reach beyond their traditional base.
Very strategic. And on the tech front, of course, we have NVIDIA, a company that has truly redefined the AI landscape. Bloomberg recently detailed their incredible rise. It's just a fascinating journey from a gaming startup to this AI behemoth.
Absolutely. NVIDIA's evolution is remarkable. It really offers a glimpse into how foundational technology can just transform an entire industry. It arguably kicked off in a big way with their 2006 launch of CUDA. That's the platform that enabled their GPUs for general computing beyond just graphics.
Right, that was pivotal.
It laid the groundwork for future breakthroughs. Notably, the 2012 AlexNet achievement, which powerfully demonstrated how GPUs could drastically cut training times for machine learning models. That really lit the fuse for the current AI boom. More recently, NVIDIA's had triumph after triumph. Their H100 Hopper chip is essentially the engine of modern AI, and Reuters reported on their pivotal role in the massive $500 billion project Stargate for U.S. AI infrastructure. They even briefly became the world's most valuable company at $3.3 trillion back in June 2024. Some analysts were predicting it could even hit $4 trillion.
Just staggering numbers. But despite that meteoric rise, no company's journey is without its significant hurdles, is it? What are some of the most significant challenges NVIDIA has faced, maybe beyond the obvious market competition that might surprise you, the listener?
That's a great question, because the narrative often focuses solely on the successes, right? But despite the soaring highs, NVIDIA has faced significant headwinds, some of which are quite revealing about the broader tech landscape. For instance, their stock dropped nearly 17%. That's a $589 billion loss in value back in March 2025.
Wow, what triggered that?
It happened after a Chinese company, DeepSeek, released a reportedly low-cost AI model. That highlighted the intensifying global competition in the AI space. Then, in April 2025, the U.S. banned the export of their H20 chip to China. That impacts their reach in a crucial, rapidly growing market.
Geopolitics striking again.
Exactly.
Yeah.
And they've also been entangled in legal battles. There was a $5.5 million SEC settlement in 2022 over cryptocurrency mining revenue disclosure. And going back further, a 2016 settlement regarding their GTX 970 graphics card performance. Plus, they continue to grapple with persistent supply chain issues, which were exacerbated by the pandemic and these ongoing trade wars. It impacts their ability to meet the insane demand.
So even at the top, it's a constant battle on multiple fronts.
Absolutely. These challenges really illustrate the complex environment even a market leader like NVIDIA has to navigate.
Moving on to some global economic perspectives, let's touch quickly on Japan's economy. It's showing some mixed signals, according to analyses from Yahoo Finance. Manufacturing activity actually expanded in June after 11 long months of contraction. The PMI, the Purchasing Managers Index, hit 50.4. That indicates growth above that 50-point mark. However, overall demand remains muted, and new business and export sales are actually declining. What does this tell us about Japan's position right now?
Well, it tells us that while there's a flicker of life in manufacturing, which is positive, Japan still faces these deep-seated structural issues. The muted demand isn't just about external factors like U.S. tariffs, though they play a part. It's also influenced by, an aging population, deeply ingrained domestic consumption habits, things that don't easily spur rapid growth.
So the internal factors are still a major drag.
hmm And the declining new business and export sales are particularly concerning because Japan is, fundamentally, an export-driven economy. If global trade uncertainty continues, especially with ongoing tariffs, it puts immense pressure on their recovery prospects. This also implies Japan's economic struggles could continue to weigh on global growth projections, even as other parts of Asia show more resilience.
Okay. And if we connect this to the bigger picture, China's response to the Middle East conflict is particularly insightful, isn't it? Reuters reported that while China strongly condemned the U.S. attacks on Iran, its business optimism in the Middle East actually remains remarkably high. What's driving that dynamic?
Yeah, what's truly fascinating here is China's strategic balancing act. It's quite something to watch. We're seeing, for instance, Chinese shipments to Dubai's logistics hub rise 20% this month. Chinese merchants are expressing strong optimism about the region as a growing market.
So, business as usual, or even better than usual.
It seems so. And remember, Beijing has played a significant diplomatic role here. They famously helped Riyadh and Tehran restore diplomatic ties back in 2023. That showcased their growing influence. The U.S. has even called on China to help prevent Iran from closing the Strait of Hormuz, precisely because China is Iran's largest oil customer. So while politically condemning the U.S. strikes, China is simultaneously ensuring its economic interests in the region are not just protected, but actively expanded.
So, it's a very nuanced position for China, balancing those geopolitical statements with very clear economic intent.
Exactly. While the risks are certainly elevated, you might see slower ship movement, fewer flights, things like that. Some analysts even suggest something quite counterintuitive. They suggest that if U.S. sanctions on Iran were actually relaxed somehow due to this escalation, tens of thousands of Chinese businesses would likely rush to invest in Iran's tourism, real estate, infrastructure.
Interesting. So, an escalation could paradoxically open doors for Chinese investment if sanctions ease.
It's a possibility some analysts are floating. It really highlights China's long-term strategic view and its willingness to capitalize on shifts in the global landscape. Makes it a critical player to watch in how these conflicts evolve and potentially reshape trade routes and investments.
Okay, so what does this all mean for you, our listener? We've seen how a single geopolitical event, like the U.S. strikes on Iran, can send immediate ripples through oil, currency, and stock markets. It complicates the Fed's calculus, even as companies like Amazon find creative ways to grow by targeting high-margin segments. And NVIDIA continues to drive the AI revolution forward amidst its own distinct challenges. The key takeaway here, I think, is the interconnectedness of seemingly disparate global events and maybe the surprising resilience of markets to short-term shocks, even as those fundamental economic questions about inflation, interest rates, and technological disruption continue to unfold.
Yeah, ultimately, while markets have shown this remarkable resilience to the immediate geopolitical shocks, the underlying questions remain, don't they? Questions of sustained inflation, perhaps driven by tariffs and energy prices, the future path of interest rates, which is still very much up in the air, and of course the long-term implications of AI's rapid growth. They all continue to shape our financial future. How might these seemingly disparate forces, geopolitics, monetary policy, tech innovation, how might they coalesce into an unexpected aha moment for you in the coming months? Something to think about.
Indeed. Lots to keep an eye on. We'll see you all tomorrow morning with new headlines from major financial magazines.